Hello dear traders, here one more time Eric Munoz in Lion Bull Academy. Today I have very interesting video, so let's faster explain what it's about. Maybe you have interest to stay or no, so let's, because it's gonna be not so short video. So we're gonna talking today about what is a short, what is sell, the faster and easy explanation that I can. What is a hedge fund? Why the hedge fund goes short? What is Wall Street bet? What is a short squeeze? What is going short in the CFD market? And where to see the short position in the internet? So let's start with the first one. What is going short? Okay, let's explain easy than possible. If you want, at the end of the video, you have one link to another video that is explained only about shorts, but it's about CFD shorts. So you can also look in that. Would be nice to look in and understanding, I think, better. But let's explain here faster what is. Okay, normally when you go to a stock, let's say an example Apple, and I think everybody know when you trade him, you just click in buy, and it's just to put how much money you want to invest. It means how many shares you want to buy. Click in set order or click open the trade, and you have already your position with 1, 2, 3, 4 shares, how many you want to buy. But now, sell is a little bit different. Sell is like that. Normally for sell, what do it? The normal market is not the CFD market. The normal market for sell is just borrow a stock from somebody, from some broker. You just borrow that stock and you put in the market. You sell it for the price of, I don't know, 131.70 like Apple now, in hope that the market will going down and rebuy that stock for a less price, like let's say 90, and then you keep for you the difference, that is $41.70. So, and give back that stock to that broker or to that person that was borrowed for you. Like this is how it's working. This is a normal sell. Okay. Really, that what nobody, really not too much people explain in the internet is why that's happen. How is possible if that person can be sure that the price is going down? How they do that? How is this even possible? So normally when you take a big amount of shares, of stock, of units, and you put into the market to sell, when somebody buy, the price going down automatically because have a lot of supply, a lot of demand, and supply are also very bigger. So when you have a lot of demand, but also supply is very higher, the price slowly start going down. I hope I explain myself good. Let's make more simple. What really moving the market is the balance through buy and sell. And they do it by orders. If you put one order of buy in a price, I don't know, of $90, and all the orders of the market are around that range, like every say 100 person are trading and everybody want to buy the stock at $90. So what do the market automatically start going down, fulfill that orders, then that push the price down. Then what really do it, this big hedge fund, is put orders of buy that stock back in a very low price. That's when they take the stock borrow, and they said it was 130, and then they put the order of buy in $90. The price automatically gonna start going down to fill that order. Then they are buying back in $90 and save that different when they give back to the broker or to the people. So that's how working a sell. It's just that one. In the market that nobody explain it in internet exactly, not too much people explain about this, not too many videos about that, is that it's moving by orders also. If a big amount of order, like let's say I want to buy stock in $90, what I do is put a lot of order, like I want to buy 1 million of shares in $90. That's gonna be so big order that the price automatically gonna start going down for fulfill that one. Many persons gonna want to sell their stock. What happened when doing this one hedge funds, very big ones, and put orders so big, so down, they push the price down. But they themselves, they have this option. That option is working not like the real stock, it's just a borrow stock. Is that option that they rid of, like this, they don't have anymore that stock, and they rebuy down. That's exactly how it's working in the market. If you want to push the price higher, what you do is you put order of buy in a very high price. That's gonna push the market very high. We, in a small how we are, we cannot do that. But when we unite all together, then it's possible because we can move in a lot of money like this. Okay, I think I exaggerated a little bit too much explaining about sell. Sell, easy way, is borrow a stock from somebody for after rebuy the stock in a price more lower for give it back to that person and keep the difference of the price. That's it, what is sell. Next one, I hope I don't make you too much headache. Next one, what is a hedge fund? Hedge fund, it's just a company that many investors who don't know how to trade, we can say don't know how to invest, just give them money, they deposit inside that company, and that company is who manage the money, the funds, the deposits for buy and sell stocks. Is what we do normally alone, they do it with all the money together. What is the good of this? More money is together, more easy to move in the market. That's one of the good stuff. Second one, if the price of the hedge fund going up, it means they trading very good and they make a 30% profit in a year, your deposit gonna go up also 30% profit. It's the same like when you copy a person in Etoro. When you copy one trader, like say you invest $1,000, his account in a year, in 2 years go up 30, 40, 50%, then also your copy going up. That's how working, we can say the easy way, the hedge funds. You can have your own hedge fund inside of Etoro. Now, why the hedge fund goes short is two reasons why they go in short. First one is how I already explained you, make profit by the movement of the price. When they rebuy the stocks in a price lower than the price of the share they was borrowed, they make the money in the difference. Second one is for destroy companies. Yeah, it is like that. Normally the same person who borrow the money to this company, like say a hypothetical scenario. Let's say we have GameStop who borrow a lot of money from one of these hedge funds, like 200 million. Then his company start not going good, going down the price, stuff like this. Then what do it? The hedge fund, for make money from it, they start going short to that company till go completely bankruptcy. Then after that, they make money by this squeeze, that short movement. They make money by that, and also make money by selling all the assets of that company and get back all the money they was borrowed like this. Normally all, or at least most of it. But normally they are very clever and do this stuff a lot of time. What is the wrong stuff of this? That a lot of people lost job, they destroy the small business like this, and they do it all the time. That's supposed to be legal, but they doing all the time. So now you know why they go short. Easy explanation. I say the two main reasons why they go short. What is Wall Street Bet? Wall Street Bet is just a forum inside of Reddit that is about a lot of retail investor, small fishes, that really they like to go very high risks most of the time. It's really funny place to stay in. Really, it's really fun to look inside because they make a lot of jokes and really you enjoy to reading what they have here. But sometimes there inside have also very clever people, and one of them or someone of them find out about Melvin Capital that was going very short inside of GameStop, and then they decide all together. At the time I was start this news, there was inside 2.4 million people inside of Wall Street Bets. They all together start buying the stock for like this, go against that Melvin Capital, because he was oversell that company, even a 34% above the real number of shares exist of that company. So was really incredible the situation. By doing that, Wall Street Capital become very big one, and now they are 6.7 million person, and everybody is joining this fight, this war, and they are all buying GameStop all the time. And what is happening is going up the price. And then we go now to the next point. That is talking what is a short squeeze. That's exactly what is happening right now with GameStop and the Melvin Capital hedge fund. Let's go a moment to GameStop. So, GameStop is skyrocketing, and I explain you why now. When they see that Melvin Capital is 134% sell of this company, they choose to buy the stocks. If you start buy, it was very cheaper. The stock was around $14 a share, so very cheaper. When a lot of people start buying the stock, really a lot of them, we're talking about 2.4 million persons buy this stock, start pushing the price higher. Then Melvin Capital, because it's in short, it's in sell, start lose money, because the losses in short can be a lot bigger than what you can win. It's very dangerous way to trade. Normally, only big guys like to do that one. Exists a lot of short traders, but I think it's not the right way to do it. So they start buy more stock, and then Melvin Capital start lose more. Then what they have to do it? Melvin Capital, for cover this position, is mean for protecting themselves. They need to start buying also the stock. Like this, they losses will start be fixed for after resell when they are more higher. But what do that? Make the price go even higher, and then people like this is like a loop that every time need to buy more and more stock, and then the price gonna go higher and high. The only problem have a short position in the normal market is they have expiration date. It means they have to a certain time to cover that position before they need to give back that stocks. If they need to give back, what happened? They need to close that position in loss, in a very big loss. We're talking, I think now it's around 11 billions. And that is what's called a short squeeze. It means squeeze the shorts. That's all what this is. Okay, now that you know a little bit also about that, let's go to the next point. What is going short in CFD? It's very similar to going short in a normal market. The only difference is don't have an expiration date. That's nice. You can hold it how much you want it. The bad part of this is that normally who go against you will be your own broker. What mean that? If you go in short in a company and you are making money, who gonna lose money gonna be your broker, because the most of the time the broker gonna be your who gonna go against you. That's normally. It's a market maker procedure. It's very normal. The most of the time for them, for the brokers cover their position, they gonna do or send your position to the real market. It means put option of sell like you are doing. Like this, they only gonna make money by the spread. That's the normal stuff they do it. But the most of the time, they don't do that. They are going against you. That's why, example, in GameStop, when you're gonna try to open a position, example here in Etoro or in other any broker that's happening now, you don't have the sell opportunity. You cannot go short in the market because there here can lose a lot of money. That's all what I was want to say. So now you know also what is the difference of CFD and real market is that normally the same market maker, the same broker is your it go against you normally. If you win, they lose in the short position. Also in leverage position, the most of the time they do the same, but normally they like to cover themselves for this don't happen, and like this win money by spread. So now you know also what is short squeeze. Let's go to the next short squeeze and what is short in CFD. Sorry. The next one and the last one will be where to see where is the shorts. So we have some different, exist many, but I'm gonna show you the most eye looking. One is go to Nasdaq short interest. You just write it in Google, Nasdaq short interest, and you can go looking by companies and know how much shorts is inside that company. Second one is go to market beat and go looking the largest short interest position. gonna show you all the companies who are in short and how much percentage, how much days to cover, and all the information. And the number 3 will be the NASDAQtrader.com, where you can see the schedule for the publication. It means every 2 weeks, normally, you can see here the dates, coming out this information. Like this, you know where are the shorts. The bad part of this one, you don't know in real time. You know only every 2 weeks. So keep this in mind when you're searching for shorts to cover, when you're searching shorts to attack. So that was everything. I hope you understand what I was want to explain. I know it's not so easy stuff, but it was really important and you know at least part of this. If you have some question, you don't understand something, just please comment me down below. I'm gonna be happy to make another video for explain the part you don't understand. If you like this video, just please click the like button and don't forget to subscribe to the channel. So see you next time. Ciao guys.